Hello friends, welcome to Kavita's Classroom. In few of our previous videos, we had been talking about the market failure situation, the situation where the demand and supply forces of market do not get the social optimum level of output at the required prices. There are a number of reasons to it and a number of solutions are used to overcome this problem of market failure. So today's discussion revolves around the topic buffer stock, how buffer stock would be a help in such cases of market failure. So let's proceed ahead to know what is a buffer stock. So it talks about a reserve of goods or raw material, right? And it ensures the stability of prices and the supply. It means it simply prevents the supply chain disruptions and manages the fluctuations of demand and supply in the market. So, how the usage of this buffer stock is done, let us do it pictorially. So it's a traditional market structure which showcases a demand curve sloping downward, supply curve moving upwards, right? It's intersecting at E equilibrium, which determines the price P and quantity Q. Right. So, what is this yellow highlighted area? It's the tolerance which is kept by government. What does it mean? That if there is a deviation within this range or tolerance range, the government doesn't do really any sort of action because that's acceptable. But if any deviation happens beyond this range of price, then government takes action. Right. So if now the present situation is the excess supply or glut leads to price crash. For some reasons, the supply is high in the market. For example, in the harvest season, it is a usual phenomenon. That supply is more than what is required. So because of that, supply curve shifts rightwards, leading to a crash of the price from P to P dash. So what is the effect? The price crash leads to exploiting conditions for farmers or producers. Why? Because they had put their heart and soul in the production process, and at the time of harvest, they're not getting the required and genuine prices of their produce. So what should be done and what government does to save them? So the solution is increase in the demand by government to buy buffer stock. It means government creates demand in the market as a counter effect of the increased supply so that the prices are maintained and the things are resorted to. So let us see how does it happen. Let us extend this price line, right? So it means this is the extra amount of supply which is there in the market. So to absorb this much extra amount, government tries to give extra demand, means government procures this much in form of added demand for the buffer stocks. So because of this, the E dash now has come here and the price is restored back to P position with because there is extra demand, extra supply. So there is extra quantity bought and sold in the market, but the prices now have been controlled. So the effect of this is, as I have shown in this diagram, that rightward shift of demand curve will lead to the price rise and the things would be settled. Let us see the other case of buffer stock. The other case is when the excess demand is there in the economy. For some reasons, the demand has risen now. Let us analyze this diagram. The traditional demand curve going down, the traditional supply curve moving up here, the equilibrium is determined and the price and quantities have been determined by the market, right? So if there is extra demand in the market, which is showcased by D dash curve, what does it lead to? The intersection happens here and hence there is a situation of price rise. Now, price rise is a problem for the buyers, the poor buyers. So it results in the exploiting conditions for the poor buyers. What does the government do now with the help of buffer stock? So just check out how much is the extra demand. The extra demand in the economy is to the tune of this quantum, right? So what does government do? Government gives the extra supply in a matching effect. Means whatever is the shortage, the government fulfills the shortage by releasing the goods from its buffer stock. So solution is by decreasing the buffer stock or by releasing the things from the buffer stock or by giving the extra supply in the market, the price is restored back to its previous position. And now that there was extra demand and extra supply, the quantity determined by this effect would be added one now. So we have now more quantity traded in the economy, but at the same previous prices, which are not exploiting. So this is how the buffer stock is used to control the market failure situations. I hope you liked it. Thanks for watching. Bye bye. See ya.